Welcome to Stock Incubator. Today we are breaking down the market question behind this story. Amazon looks simple from the outside: boxes, Prime, and a stock chart. The real debate is quieter. Is Amazon spending too much on AI or building capacity that customers may pay for later?
Most people still meet Amazon through a package at the door. That is the easy story. The harder story is hidden behind the delivery network. Amazon rents cloud computing to companies, sells advertising around shopping intent, and is building AI infrastructure that needs chips, power, cooling, and massive data centers. Here is the plain English version. Amazon is spending today so it can sell scarce digital capacity tomorrow. The valuation debate is whether investors are looking at Amazon like a mature retailer, while part of the company is trying to become an AI infrastructure landlord. That does not make the case automatic. It makes the question worth testing.
Amazon's first quarter gave both sides something to argue with. Net sales rose 17% to $181.5 billion. AWS sales rose 28% to $37.6 billion. Operating income reached $23.9 billion, and AWS produced $14.2 billion of that. In plain English, operating income is the profit the business makes before some financing and tax items. The reason this matters is simple. AWS is not the biggest revenue line, but it is the profit engine. If AWS stays strong, Amazon's AI spending has a clearer base to stand on. If AWS slows, the story gets much harder.
The boxes are visible. AWS is not. But AWS is where a large part of the valuation argument lives. Think of AWS like the plumbing for the internet economy. Companies use it to store data, run apps, train AI models, and serve customers without owning their own giant computer buildings. That is why a cloud slowdown would matter so much. It would not just hurt one segment. It would weaken the clearest profit engine inside Amazon. The key question is not whether people keep shopping online. The key question is whether companies keep choosing AWS for the next wave of AI workloads.
Now the uncomfortable part. Free cash flow fell to $1.2 billion over the trailing 12 months. Free cash flow means the cash left after the company pays for normal operations and big investments. For a viewer, it is the money that reveals how much flexibility the business really has. Amazon said the decline was driven mainly by higher property and equipment purchases, and those purchases mainly reflect artificial intelligence investment. In plain English, Amazon is building before all the rent checks arrive. The bear case says cash is getting squeezed. The bull case says the company is buying future capacity while demand is hot.
AI sounds like software, but at scale it becomes a construction problem. You need land, electricity, cooling systems, networking cables, chips, and secure cloud regions. Andy Jassy said AWS added 3.9 gigawatts of new power capacity in 2025 and expects to double total power capacity by the end of 2027. Here is the simple translation: Amazon is not only selling cloud software. It is trying to own more of the physical infrastructure behind AI. If customers cannot get enough capacity elsewhere, the company with available capacity has a better position. If demand disappoints, those same assets can become expensive pressure.
Trainium is Amazon's custom AI chip. That means Amazon is not only buying chips from outside suppliers. It is also trying to design part of the hardware itself. Why does that matter? Because chips are one of the biggest costs in AI. Management said the chips business topped a $20 billion annual revenue run rate and grew at triple-digit percentages year over year. Jassy also said Trainium 2 offers roughly 30% better price performance than comparable GPUs and has largely sold out. The simple version: if customers accept Amazon's own chips, AWS may have more control over cost, supply, and pricing.
Anthropic is important because it turns the AI story from vague hype into a named customer relationship. Amazon and Anthropic said Anthropic will spend more than $100 billion over 10 years on AWS technologies and secure up to 5 gigawatts of capacity. That is a large commitment, but viewers should treat it carefully. A commitment is not the same as profit in the bank today. The useful point is different. It gives Amazon a major AI customer tied to AWS infrastructure and Trainium. That makes the spending plan easier to understand. Amazon is not just building empty rooms and hoping someone arrives.
There is a second Anthropic issue that needs plain English. Amazon's first quarter net income included $16.8 billion of pre-tax gains from investments in Anthropic. That can make earnings look stronger, but it is not the same as repeatable operating profit from AWS, retail, or advertising. Think of it like the value of an investment moving up on paper. It can be valuable, but it does not tell you whether the core business produced more cash that quarter. This is why the script separates strategic value from earnings quality. The stake may matter, but operating proof still matters more.
Amazon also pointed to OpenAI using about 2 gigawatts of Trainium capacity through AWS infrastructure beginning in 2027, plus customer signals involving Meta, Uber, and other enterprise names. Here is the non-technical translation. The AI cloud race is not only about who has the most famous chatbot. It is about where companies run their models, where their data already sits, and who can provide capacity at scale. The risk is that announcements can sound bigger than revenue. The benefit is that the customer list suggests AWS is competing for serious production AI work, not just talking about AI from the sidelines.
Reuters reported that AWS is committing $1 billion to a new forward-deployed engineering unit. That sounds technical, but the idea is easy. AWS wants engineers to sit close to customers and help turn AI demos into working products. Why does that matter? Many companies can make an AI demo. Far fewer can connect it to their real data, security rules, workflows, and customer systems. If AWS helps customers cross that bridge, it can sell more compute, storage, databases, and tools. The service is the doorway. The cloud usage is the larger prize.
The AI story gets attention, but retail still matters. North America's sales rose 12% to $104.1 billion, and North America operating income improved to $8.3 billion. International also improved. The plain English point is that retail is no longer just a drag that AWS has to carry. It can help stabilize the company if fulfillment costs stay under control. But there is still risk. Wages, fuel, tariffs, and a weaker consumer can all pressure margins. Amazon needs retail to remain efficient so AI spending does not become the only thing investors focus on.
Advertising is the part many casual viewers miss. Amazon said advertising grew to more than $70 billion in trailing 12-month revenue. That is not a tiny side business. Amazon can place ads close to the moment people are searching, comparing, and buying. That is valuable because shopping intent is different from scrolling past a random ad. In plain English, Amazon can make money not only when it ships the product, but also when brands pay to be seen before the customer clicks. If AI improves search, recommendations, and ad targeting, advertising could become another bridge between retail and technology.
The bear case is not silly. Amazon may spend too fast. Data centers may take longer to pay back. AI customers may negotiate hard. Power and chips may stay constrained. The Anthropic stake may add accounting noise. Retail can weaken if consumers slow down. Advertising can face regulation or pricing pressure. The simple risk is this. Amazon could be right about AI over several years and still disappoint investors in the next few quarters if cash flow stays weak. That is why this is not a victory lap. It is a proof window.
The bull case is that several engines start helping each other. AWS sells more AI capacity. Trainium improves cost control. Anthropic and OpenAI increase the credibility of demand. Advertising keeps scaling. Retail efficiency supports margins. In simple terms, Amazon could become more than a retailer with a cloud business. It could become a commerce, advertising, and AI infrastructure platform where each piece feeds the next. That is the upside scenario. It does not depend on one perfect number. It depends on the pieces moving in the same direction.
The checklist is straightforward. Watch AWS revenue growth. Watch AWS operating margin. Watch whether AI spending keeps pressuring free cash flow. Watch whether Anthropic and OpenAI commitments become visible revenue over time. Watch advertising growth. Watch retail operating income. And listen carefully to management's language on capacity. The valuation case becomes more credible only if spending turns into durable cash flow. If those proof points improve together, the market may be using too simple a lens for Amazon. If they do not, the AI build-out remains a real risk, not just a growth story.